Hi there, and welcome to Know Your Options here on BNN Bloomberg. Every 2 weeks on Thursdays, we dive deeply into the world of options trading, exploring the fundamentals of puts and calls and exploring how you can effectively use them as investing tools. And we take your questions to our expert guest, Thom. You can call us toll-free, and we encourage you to pick up your phone and do so right now. Our number is 1-855-326-6266. That's a toll-free number. Or you can email us at knowyouroptions@bnnbloomberg.ca. We're going to get to your questions in the second block of the show. Now is the time to get your questions in, and we'll get Thom of Moat Financial to answer your questions on options. He's an expert. As you can see, Chris joins us right now for a discussion on some important topics within the world of options. Thom is CEO and Portfolio Manager at Moat Financial. He's joining us today from Vancouver. Chris, thanks a lot for joining us on our second episode of Know Your Options. We're ready, and I'm sure our viewers are too, for some interesting insight into the world of options. Let's begin, Chris, with a basic description of what a put is, what a call is for viewers who maybe are new to the subject matter.
Yeah, great to be here, episode 2. So, a call option is a derivative product. It's an investment instrument. So it's a derivative product based on an underlying asset. So in most cases, it's based on a stock. So a call option gives the holder or the buyer of it the right, but not the obligation, to buy a set number of shares of a set stock by a set date for a strike price. So it can be used on the buy side as a way to get leverage, and for those selling it, which is mostly what we do, to generate income. And a put option is the opposite. So it gives the holder or the buyer the right to sell a stock by a set price and a set date. It's often used as a way to insure a position or to take a negative bias against an existing stock. And so again, it can also be sold and used as a means to generate income. And again, that's sort of where we tend to focus. And you'll see that in our picks today.
Okay, we want to talk today about how options are priced. And this involves concepts like intrinsic value and time value. And we have a board that we can put up for our viewers that will assist our discussion. Intrinsic value is the option that, the amount rather, that the option is quote unquote in the money. Time value is the option price minus intrinsic value. Why don't we start there, Chris, and you can expand on those themes.
Yeah, so I mean, one thing that we are going to be trying to focus on with this show is trying to make options trading simpler. So, I think a lot of the language around it, intrinsic value, time value, all this can be a bit confusing. So we want to make sure everybody understands it so that people will use it. So when you say the intrinsic value is the amount that an option is in the money. So what that means is, let's say you've got a $50 call option on a stock. If that stock is trading at $51, so $1 higher, then that stock will have $1 of intrinsic value. So that option will have $1 of intrinsic value. But options, sometimes people say, well, who prices them and how much do they cost and how do we figure that out? Well, they are market listed. So it's bids and asks out in the marketplace that decide how much an option will trade for. So we'll keep using this $50 call option example. And so if you have a month left with this call option and it's got $1 of intrinsic, so the stock is 51, the call option is 50, you might see that option trading at $2. So the difference between how much value or intrinsic value that option has and the price that it's actually trading at in the market is known as the time value. So that's sort of what a buyer or a holder of that call option is going to pay to the person who's giving them the right to sell them that stock for that specific price. So that's the premium that gets paid for that. So if that option were trading at $2 and it had $1 of intrinsic, then we're looking at $1 of time value. And as time goes on, as we get closer to expiry, then you're going to see that time value erode, and on the last day, the only thing that will have value within that option is that intrinsic value.
And our board also indicated that volatile stocks are likely to come with higher options prices. Is that correct?
Yeah, for sure. So the biggest piece that makes up option pricing on that time value side is volatility. Or the implied volatility within that option. So again, I wish these names didn't sound so intimidating, but so if you have a stock that is moving 10% up and down a day, there's a lot more uncertainty with where that stock will be in a month or 2 months. So that time value piece of that option price is going to be higher. It just makes sense. So if you have a lower volatility stock that moves 2% a month, then that time value piece is going to be a lot less because there's less uncertainty about where that stock or that option price will be at the end of the day.
Okay, let's talk about expiries then, because expiries are important to understanding concepts like the time value of an option. We've got another board here that we can show our viewers. There are monthly expiries, which happen on the third Friday of the month. There are quarterly options, which would be the final day. I'm assuming it's the final trading day of a quarter. There are weekly options that were introduced in the United States about 20 years ago, and daily options are available on some indices and ETFs. Let's talk about expiries.
Yeah, so expiries, monthlies is the biggest piece. It's the biggest component. So that's the one that always exists. For any stock that has options listed, they are going to have monthly options. So as mentioned, those expire on the third Friday of every month, and they are going to be consistent. And if you have really high volume stocks, so the stock itself is trading big volumes, that's when the indices or the markets will introduce things like quarterlies, or then introduce weeklies, and then now they've got dailies. So basically, obviously, these markets, the CBOE or the Montreal Exchange, they are looking to make money. So if they think that people will trade something, then they will create these products. And so they've just continually introduced more and more things. So yeah, we're not big proponents of trading on these dailies, but there are people out there who, and there's some ETFs out there that just trade on options that expire the next day. If there's volume, if the markets can sell it, they will create that product.
Okay, let's talk quickly before we exit this segment and move on to the heart of the show, which is calls from our viewers about ETFs. So we do get a lot of calls on other programs about so-called covered call ETFs. Talk to us about the availability of options trading via ETFs for retail investors.
Yeah, so this is where we've seen the most growth in Canada for exposure to the options market, is these covered call ETFs. So there's about $30 billion of covered call or enhanced income ETFs. It's mostly covered calls. So we talk a lot about selling cash covered puts. That's a way to enter into positions. And I would expect you'll see growth in that piece of the ETF market. But there are all kinds of different products that are sector related or broad market related. And then I think we even talked last time about individual stocks. So, you could buy a covered call ETF that all it does is buy Amazon or Microsoft and then sells covered calls on that. So the only thing that can be a bit of a word of caution with these is to make sure you take a look at the MERs. So obviously the fees on ETFs have come down quite dramatically over the years, and they seem to have remained a little bit elevated. So if you're paying an MER plus paying a manager or paying commissions to get in and out, you should make sure that you're really paying attention to that. And if you're doing it on scale, you might want to look at actually stepping away from the ETFs and doing these trades yourself in a portfolio.
That's Chris Thom and some of his thoughts and information, valuable information to retail investors who may be new with options. Up next, we'll take your questions. So give us a call toll free at 1-855-326-6266. That's 326-6266. Or email us at knowyouroptions@bnnbloomberg.ca.